Where do you put your stop? From a day trading perspective, if you're spread betting or day trading, in fact, even if you're swing trading, this does ring true. But where do you put your stop? The most common thing people say is, I keep getting stopped out, the market keeps stopping me out and then going in my direction. Now that is probably one of two things. One is the stop is too tight. Very often we want to make as much money as possible. I do too. Every trader does. As least risk as possible, as much money as possible. That's what we're trying to do. So we always end up trying to squeeze the position size higher and tighten the stop. And ultimately what happens is we get pinged out on noise. You know, noise comes in, just takes us out of the position that we're in, probably too big really, and then goes in our direction. It comes back to the Wyckoff kind of thing. You know, you've got your stop really tight under that low, you've sized up your position for that, pings you out. In reality, what you probably should be doing is reducing the position size and putting the stop under that. So let's talk about that, under support. So you've got a chart here. Let's get a cloth and wipe this off. Let's start again. So we've got a support level kind of here, right? That's where the market's touched several times, whatever it's done, blah, blah, blah. And we're gone long at any point from here to here. And our stop is, textbook says, let's put our stop, you know, under this low. Now, as we've seen before, and as you probably observed yourself in the market, that's kind of the worst place to put your stop, because that's where markets will probe to look for liquidity. You know, not necessarily even on purpose, not necessarily people driving it or pushing it, just how market behavior works. The people who are looking to buy at the low here will just wait a bit just to see if it breaks, so they don't want to get caught. So it breaks, a little bit of people get pinged out, and then it pushes back up. So putting your stop in that danger zone, as I call it, is not a very good idea. And you can look at a chart yourself and see this. But, you know, this is the kind of thing that I did when I first started trading back in 2001, is I'd put my stop under here and I'd be thinking, why am I getting pinged out all the time? Then I realized, you know what, just widen your stop, or even better, which has really got a breakthrough, is, you know, just start buying under here. Just start buying your order here and putting your stop here. Just frame your whole trade down a leg. But anyway, that's something for another video. So stop loss under a support, that's good, but ensuring that you are well under the support. Okay, so that may mean reducing the position size a bit, and it may mean, of course, looking for an extended target to make that work for you. But if you've got it too tight, you've got it a few ticks under the low, you are opening yourself up for that little pro through that just pings you, that little long candle, you know, the one, just grabs your stop and then just rips off the highs. So, you know, you've got to be careful of that. Now, one little caveat for that, very, very quickly, is that if you've already seen the market test go through and come back up, I don't mind then personally putting my stop under there, because it's already had the test. You see the difference in putting your stop under there now and putting it under after it's had the test, because it's kind of phase one of what it needs to do to rocket to the upside. So if it's already probed, come back into the range, then by all means the stop can be nice and tight under there, because I think that once you've done the first test, you don't really want it coming back in and testing again. So that kind of thing is fine, but you notice the difference in that compared to that. And also, again, we're going down a bit of a rabbit hole here, but you'll see where I'm going with this. The difference in buying at support from a market that's come down here and doing this, risky trade, you've got the trend that way, you know, it's pushing along there, you know, you've probably got, if you think that's the low, let's say you've got a good range and you're thinking that is the low, you're going to have to give yourself a little bit more room on that. You know, you've got to admit that may well kind of do this and then come up. So you've got to be a bit cautious. Now look at that and memorize that and compare that to this one. You come up, you're flagging, and there's your support. So you've got a big aggressive move to the upside. It's flagging your support, still support, but look at it. Now it's at a high point. If you split that into quadrants or into threes or whatever, you can say, look, and it's in the top quarter. We're flagging in the top quarter. Bullish. There's my support. Now I can be a little bit more aggressive with my stop, or wait until it dips under. You know, there's a lot of difference between that and the other one we just put up on the chart. So understanding that and putting it under support or over resistance, but also knowing when to go tight and when to give it a bit more room. Next one is range based. So you can say, well, I know what, I'm long and I'm working off a 15-minute candle. My average 15-minute candle is you know, let's say 43 ticks. So do you know what, I'm going to use a 45 tick stop, whatever. You can afford to do that and say, well, that's the average thing. If I'm really, really wrong, then, it's going to take 15 minutes to stop me out for a worst case scenario. And I know that really I'm completely wrong on the trade. So you can do that, or you can look at the maximum candle of your size. So if you're trading off a 5 minute, for example, you look at the maximum range of a 5 minute candle during the day and say, hey, the most we've had is 24 ticks, right? Okay, so I'm going to make my stop a couple of ticks above that, assuming the assumption there is that if you're right, it's not going to go another full 5 minutes flat out against you. And if it does, you want to be out because you haven't called the market right anyway. So using like a range-based stop relative to the time frame you're trading. And also same if you're swing trading, perhaps you want to look at a daily range, maybe that's 100 ticks. So you multiply that by 2 and you say, okay, I'm going to use a 200 tick stop, but I'm looking for a multi-week move. I'm looking for more in it than that. So that's kind of how you go away with a range-based thing. And of course you can use a bit of a hybrid between the two. You can combine that and say, well, there is support there and there's a range. Why don't I go use my range-based stop, which is 20 odd ticks or whatever it may be, that happens to be under support. Lovely, I've got a nice combined level to put my stop. But ultimately the point of the stop is that you want to be out of the trade when you're not right. That is the entire thing. It's not really about risk management. Yes, it is, of course. You don't want to have open-ended risk. That is the point. But you've got to be careful you don't look at that too much. What you want it to do is to get you out of a trade when your trade thesis is wrong. So if you're buying a pullback and it keeps going lower and lower and lower, you want out of it. If you're buying support and it breaks through and keeps going, you want out of it. So that's the point of the stop. And the last one here we've got is time-based. So you've got to be a bit careful with this because you kind of give yourself a little bit more flexibility with how much you're prepared to lose, but it's actually quite a powerful tool to use under certain conditions. Now, what do I mean by time-based? You basically say to yourself, okay, I'm going to look, I know that the range in an hour is 50 ticks, for example, okay, 50 pips, whatever you're trading, currencies, commodities, whatever. And so that's roughly the worst case scenario, but I'm going to give myself an hour. Okay, I'm going to take the trade and then for an hour from now, if it hasn't hit my target, then I'm going to close it. And in theory that, generally speaking, you've had 50 pips. So that's your worst case scenario. So you might end up with a 10 tick loss, 20 tick loss, 10 tick profit, whatever. But you're framing it and saying, I'm in at, point number 1, which is hour 1, and I'm looking to come out in hour number 2, and it can do whatever it wants, but if at the end of the hour, I'm going to close it because I expect it to do what I want it to do within that time period because I'm trading off a strategy or a pattern that is very, very time sensitive. So again, a little bit more work required with that. You have to dig a little bit deeper and kind of understand where your risk is so you're not open-ended. You take that over some sort of non-farm payroll data, that could become quite a brutal stop for you. But these are the kind of 3 ideas of where to put your stop. But I think the main takeaway is just don't put your stop where everyone else is putting it. If you find you're in a trade and you have to put your stop where the textbook says your stop is going to be, then don't take the trade because ultimately the market looks for that liquidity intentionally or unintentionally. There's not some cartel driving it into that level, just unintentionally the way that human psychology works. So avoid that level and try and think a little bit one step ahead of, okay, if I can take the other side of those stops and then put my stop another level under that, then I might be onto something good there.